Good afternoon. My name is Olatunji Wahab, popularly known as Success. So I'm the lecturer in charge of economics at this level. So during the process, I'm having an assistant lecturer that will be joining me in this course of study. Today, we are looking at the introduction to economics and pricing system in economics. Under the study of economics, these are the learning outcomes that we are all expected to understand the concepts, the basic economic concept and principles in analysis of economic issue. We are going to be looking at the features of the general economic environment in which economic agents like individuals, firms, and governments operate. We also discuss on the basis for rational economic decisions by economic agents, which also include the individuals, firms, and governments. Then we'll be looking at the activities of regional and international organizations and their impact on the domestic economic of members' country. And lastly, we'll be discussing on the increasing interconnections among nations of the world and their economic implications. So going by the definition of economics, we have a lot of definition by different scholars, but our study, we are limited to some definition to which we are expected to have a basic understanding of this definition. When we are talking about economics, economics deals with aspects of human life and human behavior. It studies the behavior of human and their needs. One of the most important definitions that was recognized is that of Charles Robbins, of that in 1898 to 1984. So a simple and most widely quoted definition of economics is the one that is given by the British economist known as Lionel Charles Robbins. And mind you, when you are quoting a definition defined by a scholar, you don't have to add or reduce the definition. So you need to quote it the way it is. Otherwise, if you are giving definition without quoting the name of the scholar that brought about the definition, so it's better not to quote the scholar than give the definition either based on your understanding or any other perspective that you think it is best suited to define any of what you are giving definition to. So according to Charles Robbins, it defines economics as a science which studies human behavior as a relationship between ends and scarce means which have alternative uses. We're going to pick each of the words used in this definition. Charles Robbins defined economics as a science. Economics is a social science. So this studies human behavior as a relationship, the study of human behavior as a relationship between ends and scarce means that has what? Alternative uses. Now let's look at all the terms used in this definition, one after the other. It studies human behavior. When we are talking about human behavior, this is attitudes between what? Ends and scarce means. And the ends here refers to humans' wants. What do we understand by humans' wants? This is the needs of human being. And these needs are what? Are unlimited. That's part of the reason why Charles Robbins give out the definition as the relationship between what ends and scarce means that has what alternative uses. Now, ends refers to what humans wants, usually classified as goods and services. That is the wants, that is the needs of human, which refers to as ends. And the word means refers to productive resources, which is otherwise known as factors of production. And what are these factors of production? The basic knowledge of factors of production that we all know and understand, which include, we have the land, we have the labor, we have the capital, and we have the entrepreneur. So this means represent the productive resources of humans' wants, which is what? Which is unlimited. So in every society, the productive resources are combined in different ways to produce different types of goods and services. So this definition of economics by Charles Robbins has catered for all the entire behavior of human towards what they are in need of and the available resources to cater for what human needs, which is what? Which is unlimited in nature. That's why they said human needs are insatiable. Cannot measure what are the ends, what are the needs of human expectation. Now let us move on. Economics is described as a science subject, and it is based on economic study and explain human behavior. It studies human behavior concerning how best to allocate scarce resources. We are talking about resources. These are the available means, the available materials that are limited to cater for the needs of human beings. And human needs are what? They are unlimited. It is unmeasurable. So the economists study this behavior in order to allocate that limited resources, the short resources that is available for a large people that are in need of unlimited needs. So economists are now concerned with the behavior of human beings by allocating the scarce resources and more alternative uses. So the economics adopt scientific method in which theories of human behavior are developed and tested against the factors in a way similar to the practice in the pure science, like we have chemistry and physics. So now let us move on to the concepts of economics. Now talking about the concepts, this concept refers to as the terms, the terminologies used in economics. Going through the definition, please, all the terms used are necessary and they are important as far as this level is concerned. Examiner can pick as part of the short answer questions to highlight, or by highlighting ends and requesting, or we will be required to interpret or to give meaning to some of these words. Please, let's take note of all this. Now, one of the concepts of economics, basic concept of economics. So a number of basic concepts or terms, these are the terms used in economics. So the most important ones I explained in this section as we are going through all these concepts. The first one, which is economy. What do we understand by economy? This economy is a word that is used in economics. As we said, that economics is a science that studies what? Humans' behavior. And economy, which is different from economics, is refers to it may be referred to as a whole economy. Nigeria is an economy. Ghana is an economy. So the word is used to refer to a particular system of organization of economic activities. And what are economic activities? These include production, distribution, exchange, and consumption of all things required to satisfy human wants. We're talking about production. Goods and services needs to be produced before it will be consumed by human beings, which are what are required by human needs. Distribution. Before the consumption, there will be a need to distribute the production, the goods that has been produced from one location to the other before final consumption. This is one of the economic activities that we are referring to. We have exchange and consumption. Consumption, which is the end of the production activities. Consumer consume the goods. It may not necessarily be goods that are eatable. So any other goods that you are being used to carry out or to complete any process can easily be regarded as consumption. You are consuming the usage of soap, either liquid, either powder, or solid soap. So the process of making use of those goods is what is known as consumption of all things required to satisfy human wants. So in this sense, we often speak of a Nigeria economy. So economy in Nigeria can be regarded as an economy by classifying all these economic activities like production, distribution, exchange, and consumption of all things that are required to satisfy humans' wants. Or the Ghanaian economy, that is Ghana, developed or developing economy, capitalist, socialist, or mixed economics. So this is one of the basic economic concepts. Another one is goods and services. Goods and services. When we talk about goods, these are for human consumption, while services is being rendered on any activities that is expected to have been achieved. So in economics, the term goods refers to material or physical things which can be seen or touched and used to satisfy human wants. So physical can be seen or can be touched and used to satisfy human wants. That is goods. So examples include, we have food items, that is goods. We have cars, we have shoes, can be seen and it can be touched. We have wristwatch, industrial equipment, and machineries. All part of these are goods that we are referring to. Industrial equipment are also part of goods that are used to produce another goods and machineries. Goods are classified in together, please. So goods can be classified in two ways. We have the economic goods and the non-economic goods. Economic goods are those goods that have prices and their production requires scarce resources that have competing uses. So these are prices and So these goods All right, goods and services, as part of the basic economic concepts, goods refers to material or physical things which can be seen or touched and used to satisfy humans' wants. Examples of these goods items include, we have cars, we have shoes, wristwatch, industrial equipment, and machineries. All these are classified as goods. So goods are classified in two different ways. It can be classified as economic goods and non-economic goods. Economic goods can be referred to as price and their production, which are required scarce resources that have a competitive users. So these are economic goods. In form of, there will be a price and production for a particular scarce resources that will have a competitive uses in terms of production and their prices. Example of these economic goods, we can give, let me make use of cocoa, for instance. Bonvita is made from cocoa. Milo is also made from cocoa, but so while non-economic goods refers to things that are unlimited in supply and can be obtained free without paying a price. So example of these non-economic goods are stream water. There is no competition on stream water. So anybody can go into the stream and get a water. We have gutter sand. We have sunshine. Here, all these are free. That's why they are classified as non-economic goods, because there are no scarce in nature and there is no competing uses. Sunshine, everybody, every individual can make use of this here without paying. They are non-economic goods. We have bush trees and so on. So economic activities other than manufacturing or primary goods production are referred to as services. Don't forget that this is one of the basic economic concepts. As we made mention under the goods and services, we've identified the goods aspects. Now we are looking at services. So services refers to as economic activities other than manufacturing or primary goods production, which are referred to as services. So services in terms of giving rendering a service is also one of these basic economic concepts. So examples are, we have baking. we have shipping, legal, insurance, tourism, medical care. All these are services that are being rendered, so which also form part of these basic economic concepts. Baking is a process of carrying out a production process, and someone that is being engaged to carry out this baking is rendering his services to any organization that are into baking. Shipping is also a services that is being rendered to the users. We have legal. This legal is a profession, while the professional will be engaged to carry out a legal action on any legal activities. So this is a service that will be rendered from the professional. We have insurance. It's also a service. Tourism, medical care, all these are samples of services. But it is also common in economics to use the term goods to refer to both material goods and services, which in case is regarded as non-material goods. Resources, as one of the concepts of economics, are things which are combined in numerous ways to produce goods and services. So these resources can also be classified as materials that will be used to carry out a production required for the satisfactions of humans' wants. Such things are alternatively referred to as factors of production and can be classified as follows. We can have resources in terms of natural resources. These natural resources, the factors of production, these are force in nature. We have land, labor, capital, and what? Entrepreneur. But now it has been classified as natural resources because we have natural resources as land from part of natural resources. That's why this has been modified to classify resources, the part of the production, factors of production, to what? To natural resources. So these are free gift nature and free gift of nature, such as we have arable land, we have water. These are natural resources. Minerals, examples are limestone and gold. We have fishing ground, we have forest, hydroelectricity, and solar energy potentials. Natural resources are collectively referred to as land in economics. So, but they are subclassified as free gifts of nature. So on land, we can find out that there are other free gifts of nature that we can find on land. We have water, we have mineral resources, we have fishing ground, we have forest, hydroelectricity, and solar energy. So all these are classified as land in economics. That's one out of the resources that we are referring to. We have human resources. Human resources is also classified as labor. So human efforts in production process that consist of various mental and physical abilities and skills. So the term labor is used for human resources, that is all human efforts, both mentally and physically, that are being put into production. Other classes of production or resources is known as capital. When we talk about capital, This is man-made resources. We have examples of roads, we have dams, we have buildings, equipment, we have machines which help in the production of goods that will satisfy humans' wants directly or indirectly. And lastly, among the resources, which is entrepreneurship. And what do you understand by entrepreneurship? So the person or the business owners who coordinate the other factors of production. And what are the other factors of production? We have the natural resources, we have human resources, and the capital. So the person that controls these other factors of production are known as entrepreneur. To produce and market goods and services, and possibly invent and innovate goods. Economic terms, for the satisfaction and need that people derive from the consumption or use of material goods and services. So these are items that are used to give out the value on goods or consumption that has been derived by individuals. Examples of this utility, we can say power utility, that is light, power consumption. We have a waste utility. So all these are classified as one of the economic concepts, basic economic concepts. We have stock and flow. We have stock and flow. This is another concept in basic economic concepts. So the term stock refers to a variable which has no time dimension. Example, we have 1,000 bags of cement stored in a warehouse pending their sales. All this production that we have been talking about will be kept in a store. Production will be required or sales will be required. So the process of keeping these goods in a store will be called stock items. So they are referred to it as variable, which has no time dimension. So example, we can have 1,000 bags of cement stored in a warehouse pending sale. So which can occur anytime. So the sales can occur at any time. On the other hand, if the variable has time dimension, it is called a flow. That is, anytime there are sales of this stock item, so we call it flow. So this can either be inflow or outflow. So in other words, the term flow refers to the quantity of an economic variable measured over a particular period of time. So it follows that 1,000 bags of cement produced or supplied per day by a cement company is a flow. We have ceteris paribus. So this is a Latin word, which also refers to as all things being equal. The assumption is that more commonly used in economic theory to isolate the effect of a change in one variable or influencing other. Example where this is being made use of is that if you are requesting for a quotation or a price of goods and services as at today, and the usage is expected to occur in a week time to come, so the quotation will be given today, and you may be requesting for a quotation that will be used for a week after. So this word is made use of when prices or items fluctuate. So anytime there will be a need to make use of this word, that's when the economists make use of this word, that equal by so period, the price of goods or the commodity may be, or all things being equal, the price as at today is so value. So this implies that all other variables or determinant factors are held constant. So economic theories are simplified and their validity enhanced with explicit or implicit use of ceteris paribus. We have rational behavior. Rational behavior, as used in economics, behavior in which economics agents, which include, we have individuals, that's a single person, we have firms, that's a group of people, and we have governments, which is the general public, do the best they can under the given circumstances. For example, the assumption of consumer rationality implies that the average consumer in his purchasing decision, which always prefer more to less, or the basket of goods that will give him the maximum utility, given so rational behavior. So the assumption of rationality permits us to explain and predict how people will act under specific condition. Example of this rational behavior is that individuals, firms, or governments has different character and behavior, and prices of goods and services also cause one of the factors that give rational behavior. So the way an average people will react to prices of commodity will be different from those that are of lower cadre of income. So this rational behavior permits all individuals to explain and predict how people will act under specific condition. Now, we move on to microeconomics and macroeconomics. Traditionally, economics is divided into two main branches. We have the microeconomics and the macroeconomics. In a simplified definition, we are talking about microeconomics. We are macro and microeconomics. In a short definition, microeconomics deals with specific segments of the economy, while macroeconomics study the whole economic at large. Microeconomics is concerned with specific segments of the economy, particularly the behavior of individual consumer, firm, and groups of firms in the industry. So as a branch of economics, controlled and rewarded in various economic activities, as well as how relative prices of goods and services are determined. So the main topics falling within microeconomics include the theory of price and wage determination. So the theory of consumer behavior The theory of production and welfare economics are all found in microeconomics. So while macroeconomics deals with the economy as a whole in general, in macroeconomics, emphasis is on aggregate economic variables, such as we have the economic levels of employment, total output and income. We have total money supply, overall government spending, the levels of tax, investment and savings, and so on. All these are classified under the macroeconomic. So it follows that macroeconomics explores the problems of unemployment. It looks and how to cater for the problems of unemployment. We have the inflation, external disequilibrium, sluggish economic growth, general poverty, and inequality in the macroeconomy. So all these are found under the macroeconomy because it deals with the economy at large. Now we move on to basic economic problems. All this human behavior, the study of scarce resources, needs, and limited resources. We are now going to look at what are the basic economic problems. For human needs to be unlimited. So the fundamental economic problems facing every society are discussed in this session. One, we talk about scarcity. Scarcity. Economic scarcity means that people do not have as much as they desire. The problem of scarcity arises as a result of the fact that at any point in time, the productive resources available in any society are limited. And the limitation to productive resources which are limited, that cannot be able to cater for the needs of human, whereas human wants are unlimited. They ask individual, what are your needs? You can find out that 80 leaves will not be able to cater for the needs of a single individual. And giving all the society to identify their needs with the use of limited resources, that's what brought about scarcity. So it follows that the amount of goods and services that can be produced are limited and inadequate to meet human wants. So therefore, every society must resolve 4 fundamental economic questions. The first one, which is what is to be produced? What is to be produced? So every society must determine in some manner what goods and services and how much of each to produce during any given period of time in order to cater for the problem of scarcity. So we need to identify what is to be produced. And before you can produce, you need to look at the needs of the society. The next question is, how is this output to be produced? That is, how to be produced. So each firm must decide how to utilize the input to achieve the optimal resources allocation. That is, the manner of combination of factors of production in order to produce maximum output quantum of goods and services possible. The next question is, for whom to produce? Who are the target markets? That is, for which categories of consumers are the goods being produced? Is it for the young, the old, or for both categories? This part of the question, fundamental questions, economic questions, that we need to cover the word scarcity. And this category, for whom to produce, as we can see, Let's take manufacturer of Indomie, for instance, as a typical sample. When Indomie was newly introduced, the target market for Indomie then was for the young category, the kids. But we find out that this Indomie were being consumed by the medium age, that is the adults, and the old people are also are also consuming this product. That's when they study the market. After identifying what they need to produce, they've solved the problem of how to produce, and now they are into the problem of what? For whom to produce. They first identify the first category, which is for the young. When they now find out that the adults are also consuming these products, so they have to do what? Look for the quantity or the size of what can be consumed by what? By adults. That's why they come about the next quantity, the next gram. After that, they move on to another bigger grams. So lastly, how to facilitate future growth. So the resources must be utilized at the rates that would enhance future production possibilities. Now, scarcity is the most fundamental economic problem facing every society. So if resources are not scarce, goods and services will not be scarce, and there will be no need to economize. Consequently, there will be no need to study economics if these four fundamental economic questions can be solved. Another basic concept of economics, which is choice. Choice, when we are talking about choice, choices become necessary as a result of scarcity. Why do choice become necessary as a result of scarcity? Is because humans want our what? Unlimited. So that's why choice will become necessary. You'll find out that quality of goods to be consumed were being separated because of what? Because of limited available resources. So making a choice implies giving up something in order to get something else. So the concept of choice relates to all the three main economic agents in the economy. And what are the three agents? We have the individual, we have the firm, and we have government. An individual consumer must choose among types of goods and services between present and future consumption because of his limited money income. Why? Limited money income in terms of salary. So there will be a choice of goods that will be that will be consumed or that will be preferred by individual consumer. We have the firm, which must choose what to produce and how to produce within the constraints of imposed by its limited resources. And part of these limited resources may be the materials, raw materials that will be used in production. Demand might be higher than what a firm can produce. So the choice will now become what is the available resources, limited resources for a firm to carry out their production based on the demands. And lastly, we have the government must decide what public goods and services to provide for the people given its limited revenue as projected in the budget document. The government will give a forecast of what they are expected or what they want to achieve in a fiscal year. But due to the limited revenue that is being generated by the government through taxation or grants or borrowing, and if government can find out that they won't be able to cater for what they are being budgeted for, that means the government has to have their choice, that is alternative, to provide for the public or the citizens. Another concept is scale of preference. We have scale of preference. The scale of preference is a term used in economics. It is described as a list of all wants to be satisfied, arranged in order of priority or importance, as we have defined this under humans' needs, humans' wants, which are what? Which are unlimited. So out of these unlimited needs of humans, there will be a priority or importance in humans' needs. So the list of items of all the needs or wants to be satisfied will now be arranged according to what? Their priority. For instance, students that are resuming back to school, they're having their list of items for the resumption, out of which they have been listed. There will be some that will be having priority than other. Students will need school bag, they will need sandals, there will be a need of shoe, there will be a need of school, food items. There will be a need of materials, study materials. There will be a need of beverages. There will be a need of other items. But because of limited available funds that will be provided to the students, that's where the scale of preference will set in. So with this, all the items that are needed by the students will have to come in order of what? In order of priority. The concept of scale of preference underscores the basic assumption in economics that every economic agent exhibits rational behavior in the process of making a choice. So the scale of preference is a list of all wants to be satisfied will be arranged in order of priority or importance according to their importance. We have opportunity cost. Opportunity cost. This is a word used as part of the basic economic concept, which will give a reference to scale of preference. After identifying all the priority needs, other items will become opportunity cost. Economics use the term opportunity cost to mean that next best alternative forgone in the process of making a choice will be known as opportunity cost. So to an individual consumer, the opportunity cost of a commodity bought is the next most desirable commodity he could have bought instead. For example, a housewife desires a tin of rice and a tin of beans, each selling for 200 naira. But since she had only 200 naira, she decided to buy a tin of rice. Now, the opportunity cost of a tin of rice bought is a tin of beans forgone. So other items that are left from the scale of preference will be regarded as the opportunity cost. The concept of opportunity cost is central to the study of economics because it guides the individual, firm, and the government to make rational decisions on the use of scarce resources. Opportunity cost is alternatively referred to as real cost or economic cost. Scarcity. The boundary formed by the curve joining points A and F indicate that there is a limit to the amount of rice and butter that the country can produce at a point in time. Now we have the economic systems. Economic system describe the mechanism by which scarce resources are allocated in society, the nature of the relationship between the individual and society, and the role of government in allocation of resources, and the direction of economic activity is regarded as economic system. Now, types of economic system. We're having three types of economic system. Three main types of economic system, which are, we have the capitalist economic system, socialist economic system, and we have the mixed economic system. We take them one after the other. The first one, which is the capitalist economic system. This type of economic system is otherwise known as free markets or free enterprises or laissez-faire economic system, which is based on private ownership and the freedom of individuals and firms to conduct their economic activities without interference from the government. That is, there is a free movement, free policy to be carried out by individual and firms without the interference of what? Of the government. Government will not have control in the capitalist economic system. So this is a freedom of individual and firm to conduct their economic activities. As an individual, I have control over the goods and services that I need to produce and distribute. Individual organization also has the control and the process they can carry out their activities on their production and their distribution. Now let's take a look at the features of the capitalist economic system. The main features of the capitalist economic system include the following. We have the private ownership. Private individuals and firms own the means of production and goods in the economy. So that's one of the features of the capitalist economic system. I can own my individual company and control and have control over the production of goods and the distribution of the goods and services. Freedom of choice. Freedom of choice. Individuals as consumers are free to spend their money, income on those goods they consider desirable to satisfy their wants. I work as individual, I receive my salary as individual, so I have the freedom to spend my income as I deem fit. So this idea is called consumer sovereignty, and it influences what the producers will produce at any point in time. So hence, the statement in the market, economic consumer is the king, or it is mostly used as customer is always right. Similarly, the firms are also free to produce any goods they want. So as a company or as individual company, they have the freedom to produce any goods they want and which they are capable of producing. Another features of capitalist economic system is limited role for governments. Limited role for government. So the functions of the government are limited to the provision of enabling environments, rules and regulations for private economic activities to thrive. That is, the government will have a limit to what control they can have over individual company. We have competition. Individuals and firms freely compete for goods and resources. So you have a freedom of competition. I can benchmark and look at the close substitute products that my competitor are producing. What makes the other competitor goods to be more preferable? It might be in terms of quality or in terms of price. So there is a freedom of what? Competition. Therefore, in the pure capitalist economic system, the fundamental questions of what to produce, how to produce, and for whom to produce are resolved by what? By price mechanism. That is the interplay of the forces of demand and supply. Let's take a look at the advantages of the capitalist economic system. Optimal allocation of resources. Producers engage their resources only on those goods which appear to yield maximum profits. When there is a perceived opportunity in an organization that there will be a decline in a particular product and there will be an increase on the other product. So there will be an optimal allocation of resources to that goods that will yield what? Maximum profit. Greater output and higher income. There is increase in production and productivity leading to increase in income. Savings and what? And investment. This is another advantage of capitalist economic system. We have increase in efficiency. Increase in efficiency. So the presence of competition leads to a better use of resources to obtain cost. That is, when there is a competition, either in terms of price or in terms of the quality, it will lead to a better use of what? Resources to obtain cost savings advantage. We have progress and prosperity. Intense competition promotes invention and innovation, thereby bringing economic growth and prosperity. Let's take a look at the disadvantages of the capitalist economic system. Emergence of monopoly. Cutthroat competition may force small firms who could not cope to shut down, while the big firms may emerge and monopolize the markets and charge exorbitant prices when there is monopoly. Intervention. There will be a cutthroat competition between small firms. And this who could not be able to cope to shut down, while big firms will have the advantage to merge and monopolize the market, and they will charge exorbitant prices. We have inequality problem is worsening. So the rich who own resources and control production are favored, while the poor become more impoverished. Inefficient production. More resources are allocated to the production of frivolous goods that are desired by the rich who have the means, while the basic necessities required by the poor are in short supply. And lastly, we have an economic depression and unemployment. When there is excessive competition and unplanned production, this will lead to excess supply, low price level, and cut in the numbers of workers employed. Let's take a look at the second types of economic system, which is the socialist economic system. The socialist economic system is also referred to as command or centrally planned economy. As we can see from the word command, this is a control over individual or a group of people. So the economics of former Soviet Union, Cuba, and a number of Eastern European countries are often cited as example of socialist economy. Now let us take a look at the features of the socialist economic system. We have the public ownership. That is, means of production are owned entirely by the central government. So the central government will have ownership of all production, and the control will be from the central government. We have public allocation and distribution. So the prices of goods and services are fixed by the agencies of government. There won't be a price control. So there will be a general price of goods and services. In other words, the fundamental economic questions of what to produce, how to produce and for whom to produce are solved by what? By the government rather than individual or firm. Now let's take a look at the advantages and the disadvantages of the socialist economic system. One of the advantage is that greater economic efficiency. The government ensures that resources are allocated to those sectors where they can be used most productively. That is, there will be a focus on which of these of the government agency that can make use of utilization, that can utilize resources productively. So therefore, production efficiency is greater than under capitalist economic system. Absence of wasteful competition under the socialist economic system. There will be absence of wasteful competition, that is, duplication of goods and services or use of resources on excessive advertisement campaign will be avoided. Less inequality of income. So every member of the society is taken care of within the limits of their relative capabilities and the overall resources of the states. Another advantage here is that absence of exploitation, there won't be any exploitation of private monopoly. So state monopoly exists only to promote overall economic well-being of the people. We move on to the disadvantages of the socialist economic system. Misallocation of resources. Resources allocation is based on trial and error basis and selfish interest of the ruling class, leading to underproduction of goods required by the poor majority. We have loss of consumer sovereignty. Loss of consumer sovereignty. So consumers are restricted to only the goods and services dictated for production by the state. So consumer will not have any freedom of any goods or items to be purchased. No freedom of enterprise. There is no freedom of enterprise under the socialist economic system. So every person is employed by the government, and there is tendency for underemployment, misallocation of human resources. We have waste of resources. Central planning requires large bureaucratic structure, which results in waste resources. And lastly, we have poor quality products. Since all the production will be carried out by the central government, so there won't be a competition on either one product is having quality on the other quality. So the absence of competition weakens the drive for producers to improve on product quality. The third types of economic system, which is the mixed economy, is an economic system which combines features of both the capitalist and the socialist economic system. So in a mixed economic system, there exists private and public ownership of productive resources. So in those areas where the private individuals and firms are dominant, allocation and distribution of resources is done by price mechanism. It will be price that will give a distinctive difference between the capitalist and the mixed economy. But in those activities reserved for the government, central planning and administrative flat decisions are used to solve fundamental questions on allocation and distribution of resources, goods, and services. And let's take a look at advantages of the capitalist, of the mixed economy. We have best allocation of resources. A mixed economy combines goods feature of both the capitalist and the socialist economic system. Therefore, the resources of the economic are utilized in the way that ensures the adequacy of all types of goods and services with production efficiency. So the both system, we have to look for the best feature to be used in allocating resources. We have general balance. So the competition and cooperation between the public sector and the private sector will favor the realization of a high rate of capital accumulation and economic growth. We have welfare states. In a mixed economy, there is no expectation either by the capitalists or by the state. So government agencies are established to protect consumers' interests, while legislative measures are adopted to produce poverty and inequalities of income and wealth. Finally, we look at the disadvantages of the mixed economy. We have non-cooperation between private and public sector. So this is one of the disadvantages of the mixed economy. There won't be non-cooperative between the private and the public sector. So in real life, public to private sector partnership, PPP, to promote economic progress is hardly found in real life. So most often, the private sector is subjected to heavy taxes and restrictions that impact negatively on its performance. So while the public sector is given subsidies and preferences. We have inefficient public sector. The public sector of a mixed economy works inefficiently due to bureaucratic control, overstaffing of the personnel, corruption and nepotism. As a result of resources are misutilized and the level of production will be low as well. We have economic fluctuations, which is the last disadvantages of the mixed economy. Period of economic prosperity and hardship, alternating which are characteristic features of a capitalist economy, are equally experienced in a mixed economy. So this is as a result of improper mixture of the features of capitalism and socialism. And generally, we need to talk about the functions of an economic system at large. So every economic system performs the following functions. Either it's a socialist or capitalist or mixed economy. So they all perform the following functions. Allocation of resources. Every economy has to decide what and how much goods and services to produce at any given time. We have organization of production. Every economic system must also decide what alternative techniques of production are more suitable to its circumstances. Distribution of goods and services as one of the functions of economic system at large is that distribution of goods and services. So how the goods are to be shared among people is determined in every economic system. So after the production, either following the basic economic questions by identifying what to produce, how to produce, and for whom to produce, there must be a distribution system whereby the goods that have been produced will have to reach the final destination before consumption. We have economic growth and development. The mechanisms of growth to grow the economy and raise average living standard is determined in each economy. And lastly, we have the economic stability. So every economic system has the mechanism designed to control fluctuations in the level of economic activities. We have using fiscal and monetary policy. So we are still going to discuss both fiscal and monetary policy when we move on to our topics or discussions. The methodology of economics. This section addresses how economists organize their studies to make economic science a worldwide field of human endeavor. So the scientific method, we have the economic theory, and we also have words, graphs, and equation. The scientific method. Economics adopts scientific method in their investigations of economic problems and economic relationships. So in these methods, problems are identified and defined. Information relevant to the problem are collected, organized, and analyzed, leading to the establishment of an economic theory. So with the use of scientific method, so the economists prefer solution by carrying out an investigation to economic problems. We have the economic theory. An economic theory otherwise refers to as economic law, economic principle, or economic model, helps to explain human economic behaviors, especially production, distribution, exchange, and consumption, as well as to predict the likely course of future events. An economic theory is developed around one or more assumptions. So the usefulness of any theory to a particular problem situation will depend on how realistic the given assumptions are. We have word graphs and equation. In economic decision or discussions, 3 types of language are used. We have verbal, graphic, and mathematical. The verbal statements. So the use of words is often the easiest way to present or to presentation. So it has the advantages of making discussions in economics available to a wide audience. That is the verbal statement. We have graphs. Graphs in a pictorial form. There will be a graph to define the human needs or human behavior. So because of their visual appeal, graphs are used as a further aid to understanding economic discussions. Moreover, graphs provide a clear picture of a relationship between 2 economic variables. For example, when we are looking at price and quantity, we can make use of graph to differentiate or to interpret economic activities. We have equations, complex relationships, especially 3 or more dimensional relations, are expressed in mathematical language. There we are having algebra statements or functional relationship. However, for ease of presentation, variables are often reduced to 2 so they can be shown on graph. So on this equation, we use this equation to identify some economic variables as well. For instance, when we want to determine if the price of a commodity is increasing, we can use equations or mathematical language to interpret the implication. So when the price of goods and services increases, automatically the quantity that will be demanded will be what? Will be reducing. So we can make use of algebra equation to determine the price of commodity and to know what are the implications on the quantity that will be demanded. Either there will be an increase in demand or there will be a decrease to the demand. We have limitations on scientific method of economics. The nature of the subject matter of economics, which is human behavior, imposes limitations in the use of scientific method in economics. Measurement and controlled experiments, which are in the physical science, are rarely applicable in economics because people cannot be expected to behave as predictably as inanimate matter, so which can be subject of controlled laboratory experiments. Positive and normative in economics. Economics analysis can be divided into two. We have the positive and the normative economics. What do we understand by normative and what's the meaning of positive economics? The positive economics is concerned with this describing and analyzing the way things are or things will be in certain conditions exist. That is positive economics. We can use we can describe or analyze the way things are or things will be in a certain condition. For example, the statement, an increase in demand for a commodity will cause its price to increase when other factors influencing demand and supply conditions remain unchanged, is a statement in positive economics. It is positive in terms of whenever there is higher demand of a commodity, so definitely that will make the price of those commodities to increase. In other words, positive economics is an objective science which provides explanations of the working of the economic system. Now we move on to the normative economic system. This is concerned with what ought or to be or should be, what's supposed to be, particularly how economic problems should be solved. So it's a subjective science which deals with those areas of human economic behavior in which personal value judgments are made. So normative economics give rise to statements such as money supply should be reduced to lower inflation rates in the economy. So that's that about the introductory aspects of economics. Now we move on to the price system in economics. Under this study session, we are going to be explaining or we'll be looking at the pricing system in economics. We explain the concept of demand, we explain the concept of supply, we will obtain the equilibrium price or quantity in the market. We need to determine the effect of shift in the demand or supply curve on equilibrium price or quantity. And we also explain the application of demand to supply diagram to issue of price control, minimum wage legislation. Price is the monetary value of a commodity or service. So this is the money that is charged to any goods that is being consumed or services that is being rendered. So it is the amount of money one exchange for a commodity. In the free market system, the price of a commodity is determined by the interaction of the forces of markets or the forces of market demand and the market supply. So the process by which the market forces of demand and supply interact to fix the price of a commodity is referred to as price mechanism. That is the process of looking at the demand and supplies and fix a price to quantity and supply is what is known as price mechanism. So the market mechanism is the process by which the market forces of demand and supply interact to fix price and the quantity of a commodity. So we take the market forces of demand and supply one by one and explain them and further in our discussions. Now, the concept of demand. When we are talking about demand, demand is also regarded as a request. As human beings, we satisfy our wants by purchasing and consuming goods and services. So you can buy whatever you need, you can consume whatever you required, and what can make individual to satisfy their wants is what you are having as what? As your price. So in ordinary terms, demand simply means a desire. That's what you are intending to get. A wish or a want, that is demand. In economics, demand goes beyond the expression of mere desire, wish, or want. So it is desire, wish, or want backed by the ability to pay. It is not ordinary wish or want. It's a wish, but is there ability to pay? So if there is ability to pay, so we can call demand a desire or wish or want. We can classify it as want. So if what you desire, wish, or want is backed by ability to pay, it is called effective demand. So it makes it effective when you have the ability to pay. Demand is the quantity of goods or services that consumers are willing and are able to buy at a given price within a specified period of time when all other demand factors remain unchanged. So this is a wide context definition of demand. Demand is a quantity of goods or services that consumers are willing and able. You can be willing to get a quantity of goods or services, but when there is no ability to pay for such quantity, so it is not what? It is not a demand. So demand is a quantity of goods or services that the consumers are willing and able to pay or to buy at a given price within a specified period of time when all other demand factors remain unchanged. Now, the law of demand. There is a law of demand. So the way consumer react to a change in the price of a commodity is so typical that economics states it as a rule of law. So this law states that the quantity demanded of a goods or services is inversely related to its price. The price will determine what the demand of an individual will be. So when we hold constant other factors that influence consumers' demand for a commodity or services, so an inverse relationship between quantity demanded and price means that quantity demanded will increase if price falls, and quantity demanded will decline if price rises, all other things being equal. The demand schedule. Demand schedule is a table showing a list of various prices of a commodity and the corresponding quantities that will be purchased at a particular time period or at a particular period of time. When all other demand factors remain constant. So this is a what? A demand schedule. It's a table that will show a list of various prices of a commodity and the corresponding quantities that will be purchased at a particular time period when all other demand factors will remain constant. In other words, the demand schedule for an individual specifies the unit of a goods or services that the individual is willing and able to purchase at alternative prices during a given period of time. For example, let's take a look at this table. Shows the demand schedule for a commodity called amala, which is sold in bags. We have column 2.1. Table 1 shows a set of prices for amala, and column 2, the quantities of amala that consumers are willing and able to buy at each price. So as the price of amala rises from 1,000 naira through to 7,000 naira, quantity demand declines from 120 units to what? To 0 units, depicting the law of what? The law of demand. Looking at this schedule, demand schedule for amala, the price is 1,000 naira and the quantity per bags is what? 120 naira. When the price increases to 2,000, the quantity declines to what? To 100 bags. The price increased to 3,000, the quantity reduced to 80. Price increases to 4,000, the quantity reduced to what? To 60. When the prices increase to 4,000, the demand reduced to 60. When the price increased to 5,000, the demand of bags reduced to 40. As we can see, the higher the price, the what? The lower the quantity that is being demanded, which is inverse of the law of what? Of price of a demand. So as the price of amala rises from 1,000, the quantity decline from 120 to what? To 0, depicting the law of what? The law of demand. So the demand curve or graph, when the demand schedule is graphed, we obtain a demand curve. So the demand curve is a graph showing the various quantities that will be bought at a given prices of a commodity for a given period of time, when all other demand factors remain what? Unchanged. So a typical demand curve for a normal commodity has a negative slope. That is, it slopes downward from left to right, depicting the law of demand, which says that the higher the price of a commodity, the lower the quantity of the demanded as depicted. Looking at this figure, making use of the demand schedule, we can see the demand of a commodity. As the price increases, the quantity demanded is what? Is reducing. But the law of demand says the higher the price, the lower the quantity demanded. So as the price is increasing, what is happening to the quantity demanding? The quantity is what? Is declining. So from the demand, we can see the price. From the higher price, the quantity is what? The quantity is reducing up to the what? Up to the last value, up to the last quantity that will be required by the consumer. So the demand curve is plotted with the price of a vertical axis and the quantity demanded on the horizontal axis. So the demand curve, DD, is plotted from the demand schedule in table 2.1 as displayed on the graph. So the demand function or equation in defining demand, we said it is quantity of goods or services that consumers are willing and are able to buy at a given price within a specified period of time when all other demand factors remain what? Remain unchanged. Then the other factors that influences demand are expected to remain unchanged, such as we have consumer income, that is the higher the income. So the prices of related goods and services, these are other factors. Prices of goods and of related goods and services. Consumer tastes are different. What the taste I'm having for a particular product might be different from the taste another consumer will be having from the same product, and preference. Advertisements. So thus, the demand function or demand equation is a mathematical expression that relates the quantity demanded of goods and services to all demand factors, including the own price of the goods or service. Now, quantity demanded of X. Price of X, that is the own price of X. PR represents prices of related commodities or services. C represents the consumer taste. Y represents the consumer's income, and A represents the advertisement expenditure on goods and services. Let's take a look at this mathematical expression in prices of goods and the quantity that will be demanded. So don't be afraid. The functions will be given to us while the equivalent price or quantity that we are expected to use to get the price or to get the quantity that we are going to use to plot the demand schedule and the demand curve will be provided. Let's assume, looking at this illustration, that the demand function for amala is given as quantity demanded, QD represents the quantity demand, will be equals to 140 minus 0.02 P. P will represent your price, where P is the price and QD is what? The quantity demanded of the product. So we will be required to find the quantity that will be consumed when price is, now price will be given as, we're told to calculate what will be the quantity that will be demanded when price is 1,000. And we are also to find the quantity that will be demanded when price will be what? 1,500. So this will be simply calculated in this form. The demand function, that is the mathematical function, will be given. So once the mathematical function is given, we can see from that slide that the mathematical function given to us we have the quantity demanded, QD, will be equals to 140 minus 0.02 P, minus 0.02 P. This is the function. This is the function. The function will be given to us. And now we're told to calculate, to find what will be the quantity demanded if price is what? If price is 1,000 naira. So making use of the mathematical function, quantity demanded, that is 140 minus 0.02 of what? Of price. And we're told that if price is what? If price is 1,000. Now, this will now be 140 minus 0.02 multiplied by 1,000. That is 20. 140 minus 20. So this will give us 120. So that means the quantity that will be demanded for, if the price is 1,000, the quantity demanded will be 120 quantity. Now, the other question says we should find the quantity demanded if the price of the commodity is 1,500. Let me go back to the slide. The second one said if the price is 1,500, what will be the quantity demanded? So this will also be calculated. So quantity demanded, QD, if price is what? Is 1,500. So we still make use of the price function. Quantity demanded, which will be equals to 140 minus 0.02 multiplied by price. Our price is 1,500 here. So here we are going to say 140 minus, let's go and calculate, 0.02 multiplied by 0.02 multiplied by 1,500. So this gives us 30. So here we now say 140 minus 30. So 140 minus 30, this gives us 110. So if the price is 1,500, the quantity that will be demanded will be what? Will be 110. And if the price is 1,000, the quantity that will be demanded will be what? Will be 120. As we can see, as the price increases, what happened to the demand? The demand is reducing. So let's continue. So the same thing is what was calculated here. Given the demand function is given to be QD, 140 minus 0.02p. So if the price is 1,000, what will be the quantity demanded? That's 120. And if the price is 1,500, the quantity that will be demanded will be what? 110 quantity. So that is, consumer will buy 120 bags of amala if the price is fixed at 1,000. And for 1,500, the consumer will buy 110 bags of amala if the price is fixed at what? At 1,500. As we can see, the higher the price, the lower the quantity that will be demanded for. So the determinant of demand. Move on to the determinant of demand. In economics, the determinant of demand refers to the factors that affect the quantities demanded of a commodity or services. We want to look at what are the factors that are affecting the quantities that will be demanded by consumer. As stated earlier, and in addition to commodity, own price. So these factors include consumer's income. Yes, the income. Individual has different income. So based on that, you cut your expenditure according to your income. We have prices of related goods or services when there is competitive prices. Consumer taste, difference in taste, consumer expectation, population, marketing strategies, weather, availability of credit, cost of borrowing, and so on. That's cost of capital, cost that will be paid on the production. Now let's take a look at each of these determinants of demand. That is the factors that are affecting demand. The first one is consumer income. A change in consumer income may bring about a change in the demand for a goods or services. However, the direction of change in demand will depend on the type of commodity in question. For a normal good, demand might increase when consumer income increases, and demand might fall as consumer income falls, ceteris paribus. That is, all things being equal. For an inferior goods, demand might decrease when consumer income increases. all things being equal. Therefore, inferior goods are those goods that we consume more when we are worse off financially and less when we are better off. That is second-hand goods. That's inferior goods. For a necessity, a change in consumer income may not affect demand. So either the price is increasing, being a necessity, it is necessary to consume a particular product. So the consumer income will not affect the demand of such quality. For example, salt. We can't say because of the increase in salt that we will not buy salt, because this is necessity that we need before we can cook, or we use it in other things that we consume. So for necessity, the price will not affect, the consumer income will not affect the demand. Now, the next factors that are affecting the demand, which is prices of related goods. Prices of related goods. Prices of related goods. These are other factors that are affecting demand of goods and services. Goods relate to each other in two ways. Goods are either complements or substitutes. We have the complementary goods, which are goods with joint demand. So they are needed jointly. That is, if these two items are not purchased or are not demanded together, there will be a need to procure or request for the order before the use can be completed. This is a complementary goods. So before a want could be satisfied, e.g., camera and film, pen and ink, and so on. So with complementary goods, a rise in the price of one will lead not only to a fall in its demand, but also a decrease in demand for the other goods. So a fall in the price of one goods will lead to an increase in demand for the other goods. We have a substitute goods. Substitute goods, in a simplified explanation, is an alternative goods. That is, if A cannot be used, B can be of use. Example, we can make use of Milo and Bonvita. Substitute goods are goods that satisfy the same need or wants of the consumer. Example, we have pen and biro. For substitutes, a fall in the price of one leads to a decrease in demand for the other. And because of human behavior, we mostly look out for a lower price of commodity. So a fall in one of the commodities or goods which are substitutes in nature will lead to a decrease in demand for the other, while an increase in the price of one will lead to an increase in demand for the other. So when there is an increase, for instance, the two products which are substitutes, they might be having the same price, but due to the taste of a consumer may prefer to go for the other. But if there is an increase in one of these products that are substitutes in nature, we find out that there will be a decline in demand for the other products. For example, margarine and butter could be considered as sample here of substitute goods. A sharp increase in the price of margarine will let people consume more butter if the price of butter does not change. Other factors that affect demand is consumer taste or preference, and which also fall as part of satisfaction. The satisfaction that will be derived in a particular product by individual might be different from the other consumer. So any change in consumer taste or preference causes demand to change. Increased taste or preference for a particular good causes demand to increase, while declining taste or preference causes demand to what? To fall, all things being equal, ceteris paribus. Taste or preference for goods and services are influenced by advertisement, fashion, and sales promotion. Other factors that affect demand is consumer expectations. Different consumer with different expectations. The decision to buy commodities today is influenced by the expected future price of the commodity and expected change in consumer income. When consumers are expecting that their salary or income will increase more than expected, so the demand for those items will increase. So if a consumer anticipates the price of a commodity to increase in future, today's demand for the commodity will increase. But if the consumer anticipates a fall in future price, then today's demand for the commodity will fall. Similarly, an expected consumer income increase may cause current demand for a normal commodity to increase, and vice versa. Another factor here is population of consumers. Population and population changes may affect demand for a commodity. Areas of a high population may demand more of certain commodities than areas of low populations. For example, Nigeria may demand more of certain goods and services than Ghana because Nigeria's population is higher than that of Ghana. And even as the population of a country increases, the demand for goods and services will increase. Also, if the composition or structure of population changes, the demand of a certain goods and services may also change. So this is also part of the factors that affect demand of goods. So the demand of goods will also be determined by the population. Aside of making use country as an example, but also make use of state within a country to look for the difference between the quantity that will be demanded in one state compared to another state. The demand for quantity or the demand for goods in Lagos State will be totally different for the demand of goods and services in Osun State because of the population. You can't compare the population of Lagos State to that of Osun State. So this is one of the factors that are affecting commodities. We have marketing strategies. We find out that organizations spend more on their promotions and marketing strategy. And the reason behind this is that this is also one of the factors that affect demand, because there are some of these products that may not be known to the consumers, but once there are enough promotion on such goods and services, that's when the demand will increase. Marketing strategies such as advertising, publicity, and sales promotions are means used to get consumers to increase their purchases of commodity. So they are intended to inform and persuade existing customers as well as new ones to buy more of the commodity. Effective marketing strategy will lead to an increase in demand for the commodity, all of that is being equal. Example of this is that when there is a new or changes in the products, or when there is a branded that will be added, when there is a brand that will be added to the goods or products, if there is no non-available marketing strategy to introduce the new products or the new developments that will be added to the products, so the demand may not be increasing. We have natural factors. That's one of the factors affecting the demand. Seasonal variations may affect the demands for a commodity at a certain times of the year. For example, during the rainy season, demand for jackets, raincoats, and umbrellas will increase. While during the dry season, demand for commodities such as fans and air conditioners will also what? Will also rise. So there are some goods that are seasonal. So the demand for such goods and commodity will increase during their period. While when it is not their period, the demand for those commodities will what? Will have to decline because of the season variations. Availability of credit. When consumers are given credit facility, availability of credit. When consumers are given credit facilities in the form of credit purchase, hire purchase, and the use of credit cards and checks, they are encouraged to buy more goods. Granting of credit facility will increase demand for goods covered by these facilities, all things being equal. So when there is available credit given on a goods or commodity, you find out that demand will what? The demand will rise. Make use of these commodities, then you pay later. Cost of borrowing, this is interest rates, or we call it cost of capital. If the cost of borrowing is low, lower interest, then people can borrow and consume more of normal goods and services. So if cost of borrowing is high, then the people can borrow less and the investment will reduce. I'll move on to the types of demand. We have joint or complement demand. We have competitive demand. We have derived demand. We have composite demand. We take it one after the other. The joint or complementary demand. Goods are said to be in joint or complementary demand when they produce more consumer satisfaction when consumed together than when consumed separately. So examples include bread and butter, camera and film, automobile and gasoline, cassette player and cassettes. So these are joint, or we call it complementary demand, by demanding for the two items that will be used together. So this is one of the types of demand. So they are said to be joint when they produce more consumer satisfaction when consumed together than when consumed separately. So we have bread and butter. When you consume bread and butter together, camera and film, when you request for camera and film together, or instead of getting camera separately and you get film separately, automobile and gasoline, cassette player and the cassette. So these are samples of joint or what is known as complementary demand. We have competitive demand. Goods are said to be competitive when they all compete for the same consumer's income. Such goods are substitutes. Example, goods that are alternative to one another in consumption. They are pig milk and ideal milk, pork, beef, and chicken, pork meat and cow meat, and so on. These are competitive in nature. We have derived demand. This is where the demand for a final product leads to the demand for a second product, which is used to produce this final product. For example, if the demand of a product is not for its own sake, but for the manufacturing of another product which is in demand, So the demand for furniture derives the demand for wood. The demand for petrol derives the demand for crude oil. General demand for any factors of products is a derived demand. Now, we need petrol. So the general increase in demand for automobiles will also lead to increase in what? In petrol requests. Increase in demand for furniture will move for increase in what? In demand for wood, because wood will be used to produce what? The furnitures. So this is what is known as derived demand. It is the demand for one commodity that will drive the demand for the other commodity to be used in the production process. We have composite demand. A commodity is said to have a composite demand when it is demanded for alternative uses. For example, wood has composite demand because it is demanded for several alternative uses, such as the making of table, chairs, windows, doors, body of vehicles, leather for making shoes, belts, briefcase, and so on. This is what is known as composite demand. We move on to the distinction or difference between movement along the demand curve and shift of the demand curve. Demand always changes. It is not a fixed phenomenon. So the change can either reflect a movement along a demand curve or a shift of the demand curve. A situation when the change in demand is due to a rise or fall in the price of a commodity or service is described a movement along the demand curve for the commodity or service. We are going to illustrate that in figure 2.2, maybe in the next slide. When the price rises, demand constructs from Q1 to Q2. So the movement on the demand curve, DD, is to the left from A to B. On the other hand, a fall in the price from OP1 to OP2 brings an extension or increase in demand from OQ1 to OQ2. So the movement on this demand curve, DD, is to the right from A to B. Looking at the figure here, movement induced by an increase in commodities' own price. We can see P1, that is the first price. P2, that is the second price. That means any increase in price from P1 to P2, we have to lead to what? Decrease in the quantity that will be demanded. As we can see in this figure here, demand, Q2, the price is higher, that is P2. From P2, the price moved to P1. What happened to quantity? Quantity also what? Quantity also reduced. Looking at the second figure here, the same thing here, P1, that is price A. The quantity what? Increases. But when the price reduced, that is P2, the quantity also what? Also reduced, depending on what we are using to determine the quantity or to differentiate the quantity from the price. On the other hand, a situation when the change in demand is due to variation in any determinant of the demand, that is when any of these factors that we have explained earlier on is affecting the quantity demanded. So that means the curve will also what? Will also change. And what are the determinants of this of the demand that we discuss? We talk about the consumer expectation, we talk about the taste of the product, we talk about the price of goods, we talk about the consumer income based on income, we talk about the natural factors, availability of credit, we talk about marketing strategies. So all this can also affect the shift in the demand curve. So such changes in demand are shown by drawing a demand curve to the right, D2, D2, or left, D1, D1, of the original demand curve, DD, as shown in figure 2 below. So the demand curve will shift from DD to D2, D2 when there are improvements in any of the other determinants of demand, and D1, D1 when there is deteriorations in any of such other determinants, as we can see in this figure below. So this indication that the determinants of goods and services can be from the factors that may affect the commodities. Now, individual demand markets and market demand, individual demand and market demand. When we say the demand for a commodity, it means the market demand for the commodity. Since individuals consume the commodity, we may talk of individual demands as well. Now, the individual demand for a commodity is the quantities that will be purchased by an individual consumer of the commodity at a given set of prices of the commodity. For a given set of prices for a commodity, individuals will make their purchase. The set of prices and the corresponding quantities purchased by this individual consumer represent his or her individual demand. Then the market demand for a commodity, on the other hand, is the total quantities that will be purchased by all individual consumers of a commodity at the same given set of prices when all other factors remain unchanged. So a market demand is a horizontal summation of all individuals' demand for a commodity. Let's take a look at illustration in the next slide. Let us assume that there are only two consumers, John and Rose, for amala, with demand schedules as we have the price, we have quantities demanded for John, we have Rose quantity demanded, the market quantity demanded. QJ represents John's quantity demand, QR represents Rose quantity demand, while Q, general Q, represent the market quantity. As we can see, price of commodity at 1,000, John's demanded for 80, while Rose demanded for 40. But the market quantity demanded is what? Is 120. What that means is that the market demand will represent the overall quantity that will be demanded by all individual consumers. So that will be a combination of what? Individual consumers that will combine the market quantity demand. As we can see, price increases to 2,000 naira. What happened to John's demand? John's demand reduces. The same thing applicable to Rose. Rose demand also what? Reduces. But the combined market demand will also what? Will also reduce. So combination of both John demand and Rose demand give us what? Give us the market demand. So the same thing, up to 7,000 quantity price of the commodity. We can see when the price rises to 7,000, the individual demand reduces, and there was no demand when the prices as was reduced because of the what? Income of individuals, and that will also affect the market quantity demanded. So the table above has explained the individual and the market demand. So the individual demand will be based on individuals' income. While the market demand, we combine all individuals' demand to arrive at the total market demand. Now let's move on to exceptions to the law of demand. For a normal goods, as discussed earlier, demand curve slopes downward from the left to what? From the left to right. However, there are some instances when demand curve will slope upward from the left as shown in figure 2.4. So such demand curve that violates the law of demand is called an exceptional demand curve. So an exceptional demand curve would occur in each of the following cases. When there is gifting goods, what are gifting goods? These are goods whose demand falls with only a fall in their prices. When there is price deduction, when there is a reduction in price, so the demand will reduce. So these are gifting goods. We have goods of ostentations. These are goods that are generally perceived as symbols of affluence. Typically, example of luxuries like expensive cars, jewelries, expensive cloth materials, which are in greater demand at high prices than at low prices. So this will affect the demand curve as well. We have fear of future rise in price. Fear of future rise in price. So rising expectation of future price will increase demand for a commodity if a shortage is feared in the near future. For example, this usually happens when there is a fear of future rise in price of petroleum. You'll find out that there will be some petrol station that will close down, that there is no petrol in their reservoir. Because of what? Because of the fear of rising the price of the petroleum. While you will see some individual that will rush to the filling station to do what? To buy in excess in order to go and keep, because of what? Because of the fear in the future rise in the price of the petroleum. So for example, if the conditions of rising inflation are getting worse in the country, people may continue to buy more of essential items, even when their prices are rising. Consumer ignorance. Consumer ignorance. Consumer may buy more of a good when price rises due to ignorance. A consumer may be deceived by branding, advertisement, and other sales promotional strategies in this regard. When there are some people that they see the new logo put in a product, and the logo is not changing the taste, it's not changing the quality, it's because of the ignorance by the consumer that will make them to do what? Demand for more of those goods items. Consumer surplus. It is the difference between what the consumers are willing to pay for a commodity or services and what they actually pay. And this will be illustrated in figure 2.5. A simple definition of consumer surplus is the difference between what the consumer are willing to pay for a commodity or services and what they actually pay. This is a variance, difference between what you are expected to buy and what you actually, the price at which you actually bought a goods. So the demand curve shows the quantity of the commodity that consumers plan to buy at each price and the consumer surplus on each unit of the commodity. For each unit of the commodity, consumers are willing to pay higher prices than expected. However, since the consumer pay for each of the commodity, the shaded area of the triangle will illustrate consumer surplus. Given this example, the consumer surplus area of P1 RP2, that is half base times height. Looking at it here, the price of a commodity increases from P1 to what? To P2, whereby the quantity stay at what? At P1. So this illustrates the consumer surplus. So note that the height is obtained as difference between the highest price possible and the market price. We move on to supply. We have been discussing about demand. So we need to discuss on supply, because when we are describing or when we are defining economics, we made mention of distribution, production and distribution. Now let's move on to supply. Firms or producers or sellers or enterprises make decisions about the quantities of goods and services to supply to the market. So they make their decisions with respect to some set goals or objectives. The key one of which is earning as much profit as possible. That is profit maximization, which are the main objectives of private organization or entities that are producing goods for sale. Supply is the maximum quantity of goods that firms will offer for sale at a given market price within a specified period when all other supply factors other than the commodities price remain unchanged. Looking at demand, you can see demand is totally different from supply. The demand is that what the buyer, the consumer are willing and having the capacity to pay, while supply is the maximum quantity of commodity that firms will offer for sale at a given market price within a specified period of time when other supply factors other than commodities price remain unchanged. Simply put, it is a set of prices with a corresponding set of quantities that firm would offer for sale at a given time and when all other supply factors remain unchanged. And we move on to the law of supply. As we're having the law of demand, we also have the law of supply. The law states that suppliers will willingly increase the quantity of a commodity or services supplied when the price of the commodity or service rises, and it decrease the quantity supplied when the price falls. All other things remaining unchanged. This is the law of supply. A higher price gives producers incentive to increase production and vice versa. The supply schedule. A supply schedule is a table or a list showing a set of market prices for a commodity and a corresponding set of quantities that will be offered for sale by a firm. Other things remaining the same, unchanged. Looking at the table below, this represents a supply schedule. This is a typical sample of a supply schedule. If you look at this, this is inverse of that of a demand schedule. Looking at the price here, when the price is 1,000, there is no quantity supply. When the price increased to 2,000, there is a supply of 10. The price increased to 3,000, 20 supply. The price increased to 4,000, 30 supply. 5,000, 40 supply. 6,000, 50 supply. And 7,000, 60 supply. So from the supply schedule in that table, it is evident that as the price of each of these quantity rises, the suppliers are willing to offer more for sale. So as the price is increasing. Why is that so? Because there are more demand when the prices increases, and the producer are willing to do what? Are willing to supply as the price is increasing. For example, if the price of the quantity rises from 4,000 to 5,000, suppliers are willing to increase the quantity supply from 30 to 40 bags. Now the supply curve. This is a graph that shows the relationship between quantity supplied of a commodity and the market price when all other factors are held constant. The normal supply curve has a positive slope upward from left to right, showing that more is willingly supplied by firms at higher prices than lower prices. So the supply curve is a graphical representation of the information in the supply schedule. You can see this in our next slide. So this is a supply curve. As the price is increasing, the supplier are willing to do what? To supply more quantity. Price from 1,000, no supply. Price from 2,000, 20 supply. Price from 3,000, 30 supply. Price from 4,000, price from 5,000, 40 supply. Price from 6,000, 50 supply. And price of 7,000, 60 quantity supply. So the consumer are willing, the producer are willing to supply when the prices increases. So the supply function and equation, as we also have supply function and equation in demand. So the same thing we're having in supply. So the supply function or equation is a mathematical expression showing a relationship between the quantity supplied of a commodity and the factors determining that supply. So if all other supply factors are held constant and we allow quantity supply to depend only on the market price of the commodity, then we have QS, which represents quantity supply, equals to F into bracket P, where QS is the quantity supply and P is the market price. Let's take a look at this illustration. Suppose the supply function formula is given as QS, quantity supply, minus 10 plus 0.01 P, where P is the price and QS is the quantity supply. Find the quantity that will be supplied when the market price of this product is 1,000 and 1,500. So let's also illustrate this using supply function. We have QS, which represents quantity supply, which is equals to minus 10 plus 0.01 P. We have minus 10 plus 0.01 P. This is the function. minus 10 plus 0.01 P. Plus 0.01 P. So using this function, we're told that we should find quantity supply, find QS when price is 1,000. So the answer will now be QX will now be equals to minus 10 plus 0.01 multiplied by P, price of 1,000. We close brackets. So this will now be 0.01 multiplied by 1,000. So this gives us 10. So this will now be equals to QS will be equals to minus 10 plus 10. Minus 10 plus 10, this will give us 0. And secondly, we are told to find QS when what? When price is 1,500. So we still make use of this function. Our QX will now be equals to what? Will be equals to minus 10 plus, we have 0.01. Price will now be representing 1,500 here. We close our brackets. So this will now be QS will now be equals to minus 10 plus 0.01 multiplied by 1.5. That will give us 5. That will give us 15. So minus 10 plus 5 plus 15, this will give us 5. So as we can see from this illustration, so that function will also be given to us and what will be expected to calculate for exam conditions. So this simply means when the price is 1,000 naira, the quantity that will be supplied will be 0. So suppliers of these products will not supply the products if the market price is what? 1,000. But if the market price is 1,500, the supplier will supply 5 bags of the products. Now we move on to the determinant of supply. Determinants of supply include the following. The main determinant of market supply of a commodity or services are commodities' own price, prices of other goods or services. We have prices of factors inputs. We have the state of technology, government fiscal policies, that's tax and subsidies, weather and other natural phenomena, and we have suppliers' expectation. So let's take explanation of these factors one by other. The first one, which is the commodity's own price. All things being equal, the higher the price of a commodity, the more profitable it is to engage in its production. Hence, the greater will be the quantity supply. That's on the commodity's own price. We move on to the prices of other products or outputs. Competitive supply products. Firms are not permanently committed to the production of particular products because firms have the objectives of maximizing profits. Rising prices for other products could cause firms to switch to the production of these products. For example, if the price of soft drinks were to rise sharply, breweries might switch from beer production to soft drink bottling. Such products are said to be in competitive supply. So the same resources may be used to produce them. So when there is competitive supply products, so these are also be the determinants of a supply. We have joint supply products. So these are products that are always produced together. So one is seen as the byproduct of the other. Example are beef and hide. An increase in the price of, say, beef, which increases the quantity of beef supplied to the market, will automatically increase the supply of hides from which leather products are made. We have prices of inputs. So these are prices firms pay to obtain factors of production or inputs. So firms pay wages and salaries for hiring labor, rent for the use of land, and interest for borrowing capital. Interest in input prices, in turn, increases the cost of production, thereby causing supply to decrease. So a decline in input prices lowers cost of production and increases supply. We have technology. This is also another factor of or determinant of a supply. We have the technology. The kind of technology a firm uses to produce its products determines the type and quantity of inputs necessary to produce a given quantity of products. So when a firm uses the best technology available, it can produce a unit of a good at a lowest possible cost. So more of technology advancement products ask more sales than those that are not advanced in technology. So the demand for this type of goods will be increasing and the price will also be increasing. So this will also lead to what? Supply of those commodities. So an advancement or improvements in technology is the development of new means of producing a good using a smaller quantity of inputs that was previously possible. So technological innovation also results in the development of new products that are less costly to produce than the products they replace. We have government fiscal policy. This is also one of the determinants of supply. So these are taxes and subsidies. Tax increase cost of supplying a product, and anything that causes the cost of supplying a product to increase, in turn, causes a decrease in supply of the product. While subsidies decreases the cost of supplying a product and hence cause the increase in supply. Government gives subsidy to reduce the burden in the production of goods or services and for the reduction of the price from the consumer, which is the general public. We have weather and other natural phenomena. Changes in weather affect the supply of certain commodities, especially agricultural products. A favorable weather condition, such as good rainfall, will increase the supply of agricultural products. Yes, when there is a favorable rainfall, a good favorable weather condition, such as rainfall, this will increase agricultural products because this will have to increase the output of farm produce, while an unfavorable weather, such as drought, will cause a decrease in the supply of agricultural products. So other natural phenomena such as floods, bushfire, pests, and so on also affect the supply of agricultural products. Pests and so on can also affect the supply of agricultural products. We have population of suppliers or firms as one of the determinants of supply. When firms in an industry are earning supernormal products, supernormal profits, this may attract new firms into the industry when there is a huge profit on a particular product. And once individuals or governments are seeing that there are a lot of profits on that particular product, that's when you see so many people that will go into that business. So if it is not a monopoly industry, which would in turn increase the supply of the product. On the other hand, if more firms exist and industry, this could cause supply to decrease. Now let's move on to the types of supply. We have joint supply, and we also have competitive supply. Products have joint supply when the supply is of one product. It's associated with the supply of the other products. So the other products are seen as byproducts of the main product supply. Example are beef and each, that is leather, palm oil and palm kernel, gas and coke. We have competitive supply. This entails the supply of goods or services which can most easily be produced with the resources at the firm's disposal. So exception to the law of supply. This is usually discussed with respect to the labor market, whereby above a given level of wage rates, any further increase in the wage rates will cause supply of man or hour of labor service to fall. So this produces a backward bending supply curve as shown below. This is a bending supply curve when there is a backward in wage rates. So above, in the figure above, any further increase in the wage rate above W, above this figure here, will cause the worker to reduce his man or hour of work in favor of more hours of leisure. That's leisure period. Therefore, the upper section of the supply curve mark SX violate the law of supply, indicating a negative relationship between the wage rates and quantity supply of labor services, that is man per hour. Differences between movements along the supply curve and shifts of the supply curve. All of that things being equal, a movement will occur along the supply curve when a change in the supply price of a commodity leads to the change in the quantity of its supplied, as illustrated in this table below. We can see the price of a commodity A increases from Q1, the quantity also what? Increases. As the price is increasing, the quantity that will be supplied is also what? Is also increased. So this is an upward movement along the supply curve. So this is downward movements along the supply curve. As we can see here, from A, the price is reducing to what? To P2. What happened? The quantity from Q1 is reducing to what? To Q2. So this is a downward movement along the supply curve. So an increase in the commodity own price from P1 to P2 leads to an increase in the supply of the commodity from Q1 to Q2, resulting in a movement along the supply curve from point A to point B. On the other hand, the supply curve shifts when there are changes in the determinants of supply other than the commodity's own price. So these factors causing the supply curve to shift downward and to the right are decrease in factors or material prices. When there is a decrease in material price, there will be a decrease in supply. So improvement in technology and government subsidization and so on, while the converse behavior of the factors will shift the supply curve to the left. So this shift in the supply curve. As we are having individual supply, individual demand and market demand, the same thing we're having in supply. So we also have individual supply and market supply. So there is no changes between individual demand and individual supply and that of individual supply to market supply. Individual supply will be based on individual companies' willingness to supply a goods and services, while that of the market will be the combination of all individual company or individual firm willingness to supply will be combined to become the market supply. So let's take a look at a typical sample in this table. Individual supplies and market supply schedule. We have price from 1,000 up to 7,000. We have nice limited and fine limited. As we can see, nice limited, when price is 0, when price is 1,000, there is no supply. So the combination of these two give us 0. When the price was 2,000, nice supply 6, while fine limited supply 4. Combination of these two give us what? Give us 10. And so on, up to 7,000 price, we can see 35 and 25. Combination of these two give us what? Market supply of . So market determination of equilibrium price and quantity. In the competitive markets, the determination of market price and quantity is by the market mechanism. So the market mechanism in the process is the process by which the market forces of demand and supply mechanism interact to establish a market price and determine the quantity of commodity exchange in a market. As you can see in this table as well, the demand and supply schedule, price, quantity demanded, quantity supply, excess bags, and types of excess. We can see that when the price is 1,000, the quantity demanded is 120, and there is no supply. This indicates that there is what? There is excess demand. When the price is 2,000, quantity demanded is 100, quantity supply is 10, and the excess of the bags is what? Plus 90. This also indicated that there is what? Excess demand. Where we are having equilibrium is when the price, when the quantity demanded and the quantity that is supplied are equal. So that gives us what? Equilibrium. That is, what was demanded for will be the same thing that will be what? That will be supplied. That's when we're having equilibrium. And when in a situation when what is demanded is less than what is supplied, that means there is what? Excess supply. But in a situation when what is demanded is higher than what is supplied, that means you're having what? Excess demand. All right, so this is where we are going to stop today. So in our next class, we complete the price mechanism, where we are going to be talking about the equilibrium price and the equilibrium point. Then we take a look at the next topic. So thank you for your time. See you in the next class.